Hey everyone, Mike Clark here with Visionary Wealth Advisors, and now that the tax season's over, I thought it'd be a good idea to bring a CPA in to talk about the changes and just see how individuals can prepare for next year. So I have Brian Toennies with me. Brian's a CPA who has his main office in Sunset Hills. He's been in the industry for about 21 years on his own, has 14 employees, and really helps individuals and small businesses with tax planning and tax preparation. So thanks for coming, Brian. I appreciate it. Yeah. So the first thing I'd like to start off in asking you is what are the couple things that surprised your clients the most with this tax season?
A couple things. One, individuals who have a lot of miscellaneous itemized deductions, which are either investment expenses or work-related expenses for an employee, weren't allowed to take those deductions this year. So some clients lost out on, $10,000 to $15,000, $20,000, $30,000 worth of deductions they'd had in the past, and in a lot of cases it did affect their tax liability and then paying more tax.
Right.
Another item, and this was I think a little more prevalent, in February, March, the IRS changed the tax withholding tables to account for the changes to the tax code, and I think they kind of got a little aggressive, and a lot of people saw that, well, maybe they paid a little bit less tax in 2018, their withholding was even lower, so they end up even getting smaller refunds or owing tax. So they may have saved taxes, but they got it throughout the year, not realizing it, then ended up owing.
And that's always the age-old battle, I would say, for you, in that unfortunately a lot of individuals focus solely on what they get back, when the focus is really collectively over the year paying less.
Right.
Is that fair?
That's correct, yeah.
So to go back to individuals not having the ability to itemize as much, why is that? Was there a change in the standardized deduction?
Yeah, there are several changes in the standardized or the itemized deductions. Taxes were capped at $10,000, so the ability to deduct real estate taxes, state income taxes, other taxes is an itemized deduction, but that was limited to $10,000 this year. The other main change was that miscellaneous itemized deductions, which again are investment expenses, other work-related expenses, unreimbursed employee expenses were phased out completely. So we've got a number of clients, say, that are linemen or electricians who work out of town months at a time and aren't reimbursed for any of their work expenses. They were able to deduct those costs in the past and couldn't this year.
Wow. So again, just to kind of recap, if someone is taking on work-related expenses and they are getting reimbursed for it, I'm sorry, they're not getting reimbursed for it, they do not have the ability to itemize that.
Correct.
Okay,
Correct.
that's a big deal.
It is a
very much a big deal. And the other thing for us, while your main office is in Sunset Hills, you have an appointment-only office in O'Fallon. I'm here in O'Fallon, Illinois. I know you're residents of O'Fallon. So for Illinois in particular, the $10,000 cap for what's commonly called SALT, or state and local taxes, is a big deal because real estate taxes are a little heavy here.
That's right. Real estate taxes and income taxes are getting heavier too.
Yeah,
right?
Yeah. So that's a very big deal.
Yeah.
Very big deal. So, what would you say, or who were the biggest losers from the tax law changes?
I think the biggest losers were those employees who have a lot of unreimbursed expenses, traveling salesmen, people working out of town. They lost large deductions and typically aren't really high-paid people. I mean, if you're an executive working for a company making a couple $300,000 a year, you don't have out-of-pocket expenses. You're a salesman or a guy making $70,000, $80,000, $90,000, you got a lot of mileage, a lot of other expenses, you're not reimbursed, you're losing out on a lot of deductions. I think that was the biggest single loser, was that group of people.
Yeah. Well, hopefully their employers are going to change how they compensate their employees to combat
Some
that.
companies are doing that. They're
doing that?
setting up some kind of a reimbursement policy to maybe lower wages, but reimburse more. It works out better really for both the employer and the employee.
Good, good. Now, we talked about the biggest loser of the tax law change. What would you say was the biggest winner?
Biggest winner were probably that people making from $50,000 to $200,000 of income, especially if they have a larger number of dependents. They weren't hurt too much by the limitation on the taxes. they were subject to lower tax rates, and while the exemption for dependents was eliminated, the child tax credit was expanded to $2,000. So a lot of those people were getting much larger refunds or paying a lot less tax.
Good, good. One thing I wanted to say is that Brian and myself do not know you, the individual watching this. So anything that's said today is not, should not be considered advice, either from Brian or myself. We don't know the ins and outs of your situation. So we hope you enjoyed this video and have a great day.